What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we are looking at how the economy is crumbling. The floor, the economic fundamentals are just getting obliterated through many measures that are being completely ignored by mainstream financial media. Meanwhile, asset prices like housing and the stock market and gold are at or near all-time highs. So today we are looking at why the economy crumbling is actually helping keep asset prices elevated and at all-time highs, why it's actually bad for everybody. It's not a good thing that the stock market and asset prices are staying elevated at these prices, how the two are interconnected, and we're going to look at data like bankruptcies, debt, unemployment, long-term trends that started way before the coronavirus, and maybe we'll throw some nuggets in at the end on how you can position yourself through the turmoil to take advantage of the craziness. Let's dive in. All right, we've got a lot of data to cover today. We're going to be looking at a lot of charts and graphs, and so for any that I can, I will include the links in the description below. That way you can go take a deeper dive into the sources that I'm using to put this video together as well. The main thing that I want to communicate here is that the crisis we are currently in the midst of is not from the coronavirus. In fact, a lot of the things that we're experiencing now are simply results, they're simply effects of the bad policies and bad choices that Americans and our leaders have made for 20, 30, 40 years. Whenever you take a shortcut that is less painful now, you're only delaying the inevitable, and many times you're making things worse off later on. And so that's exactly what we're seeing right now. And so there's this fantastic report that was done by the Economic Innovation Group. Again, I'll link it in the description below if you want to read the entire thing. But it shows how for decades our economy has been in decline by many major metrics. Now, one of the main things that you need for an economy to grow and be successful and healthy long term is called dynamism. Dynamism, it's the state of being dynamic, right? So that's the opposite of static. If you have something static, it's dead, it's dying, right? It's volatility that gives life. Imagine a heartbeat. As soon as the heartbeat stops, it goes static, it goes flatline. That's just like any living organism. You need change, you need volatility to be alive and healthy. Once you reach a state where the dynamism and that volatility has gone away, you're dead. And so this report measures dynamism, and it's important because from the standpoint of looking at an economy, another name for that might be Joseph Schumpeter's creative destruction. So this is where it's actually a good thing when businesses die as a result of new innovations taking their place. And so it's a good thing when you have unemployment in certain areas. It's a good thing when you have bankruptcies or closures in certain areas. The destruction part is just one side of the same coin of the creation part. And so you need both elements. You need the creative and the destruction. Otherwise, the things that are old and bad and suck the life, the things that are inefficient, when those things stay around, they grow like a wart. And pretty soon, if you don't let those things die, they start soaking up all the resources and all the energy from the system and don't let the healthy parts grow. Just like pruning a plant, right? You're going to cut off all of the dead branches to help the healthy ones grow stronger. I know lots of people are getting into gardening right now, and so with your plants, you're plucking off all the little branches, all the little stems, all the little parts of the stem that you don't want on there to get the other parts to grow, to direct a lot of that growth energy into the fruit. So it's the same thing with any living organism, and economy is no different, and so you need those bad parts to die. Well, the other side is just as important. You need the new things as well. You need the creative. And so if you only have things dying, obviously that's going to be very bad as well, because you don't have anything that's more healthy replacing them. You just have a dying plant. If you want, go check out this report. I'll throw a couple graphs and charts up on the screen here, but from many metrics, you see this creative destruction simply fading away in America. You see that dynamism start to go down, and our economy, our growth, our country is becoming a lot more static. Now, one of the ways that this is measured is share of employment in new companies. For decades, this has been on the decline. The percent of our population moving across state lines has been on the decline. The job turnover rate has been on the decline. The number of startups has been on the decline. The ratio between companies dying or closing versus new companies starting has been on the decline, and 10 years ago, 12 years ago, during the Great Recession, it was the first time in our history where that number actually went negative, where we had more business closures versus new ones starting. Now, there are many reasons for this, and the reason that's behind all the other reasons is the Federal Reserve, debt monetization, printing money, inflation. It's the fuel behind all of the causes that have led to these outcomes. Now, I don't have time to go into that right now. If you want more on that, that's basically a common recurring theme throughout my entire channel, so you can go watch some of my other videos on that. But one of the other net results of that is that it favors incumbents through large increases in regulations and red tape and the difficulty in starting new businesses over the last few decades, how that has accelerated. That's one thing that prevents new companies from coming in. The cost of capital needed to do that starts to go up. The number of people eligible just due to capital requirements, the number of people who have the capability to even go risk or start something on their own has been on the decline. You have more of a concentration of wealth. All of these things favor incumbents, which ultimately favors the largest players. Now, these trends have all been extremely sped up during this current crisis that was really revealed by the coronavirus. Now, what do I mean by that? Well, number one, almost all of the gains that we've seen in the stock market, which is back to all-time highs, the same levels as it was before the coronavirus happened, are led by just a couple companies. In fact, only about 6% of the companies in the S&P 500, which is 500 companies, only about 6% of them are actually at 52-week highs, while the entire index is at all-time highs. Not even just a one-year high, it's at an all-time high right now. And so a lot of the growth and a lot of the recovery has just been due to the fact that a couple large companies have had massive gains that have driven the entire index average higher. And it's so bad, in fact, that it's actually a record. So the largest 10 companies in the S&P 500 make up more than a quarter of the total market cap. So if you take all of the shares, of a company and you multiply that by its price per share, that's the size of the company. That's called its market capitalization, its market cap. That's the total cost or the total size of the company. And just the top 10 companies in the entire S&P 500 make up more than a fourth of the total market cap of all the companies combined. So you put all the companies combined together, a quarter of the size of that by market cap is made up by only 10 companies. And that's a record. That's the highest ever. And you say, well, that's not a big problem. Yes, I agree that there's more gains in some companies, but ultimately, why does that actually matter? A rising tide lifts all boats, and eventually, if there's conditions that are allowing these companies to survive and succeed, that will trickle down to the rest of the economy as well. Well, as we looked at earlier, this is a long-term trend that has been accelerated by the current crisis. This isn't just a short-term blip that we have to figure out how to deal with extreme measures like printing trillions of dollars. The negative impacts from this are more than just large companies are doing well. Another negative effect is that bad companies who should not have survived are surviving. And this is what's known as zombie companies. It's companies with no revenue, companies with no profits, companies with sometimes even no product sales ever whatsoever are not only surviving, but they're thriving and they're soaking up a ton of capital. And investors, and most of the time it's small investors that really might not know any better, they're throwing massive amounts of money at these companies, and the odds are that long term these companies will not survive. Now, one of the reasons these companies are even still around is because debt is cheap. Debt is extremely easy to get right now, and it's basically free for the large players. And so these companies are surviving just because they're borrowing. They're switching from one credit card to another and using the new one to pay off the last. They're not selling products. They're not making sales. They're not making revenue. They're definitely not making profits. They're using debt to survive, and they're receiving a lot of money from investors because they have innovative products. And this this becomes a drag on the rest of the economy because that's actual real capital, that's real money, real wealth that's being allocated to these zombie companies that are going to destroy that wealth long term, when that wealth could actually be deployed. That capital could have been allocated to good businesses that are making money, a lot of times smaller businesses, but because they don't get the capital allocation, now they're going to fail as well. And they are failing. It's not just that they're going to fail. We have a massive number of bankruptcies sweeping across our country right now from companies that do not have access to the capital that a lot of the large players have access to, regardless of whether or not they're deserving because of their business practices or their revenue. They're just larger, and so they have access to this cheap money. And this disproportionately affects the small businesses, which actually employ most people in America. If you look at Yelp data shows that about 80,000 businesses have permanently shut down in between the beginning of March and the end of July. 80,000 permanently gone. And of those, about 60,000 of those businesses were extremely small with less than 5 locations. So these weren't massive chains. These were small mom and pop, everyday people, businesses, completely permanently shutting down. Now, again, this is a result of years and decades, really, of bad policies that have gotten the economy in the country backed into a corner where the only politically expedient option is to do something that is a short-term band-aid that is long-term devastating. And at this point, one of those choices has been that the government with the Federal Reserve has basically had to nationalize banking. Top-down processes rarely work, especially on the scale as big as the United States. And so while the Federal Reserve is printing money and has started all these special purpose vehicles through the Treasury in order to try and inject money into the economy, it's not making its way to the small businesses because it has to go through banks. And there's really no other alternative because the Federal Reserve and the Treasury, they're not set up with the structure, with the infrastructure in place to be able to deliver that money directly into the hands of small businesses. But the problem is that banks are businesses too. And so what they're doing, even though they have access to lending and they really have no risk of failure because they have no reserve requirements, they're businesses too. And so what they have to do during times like this is to tighten their lending standards. And so while there's money getting shoved in the back door to these banks, there's nothing going out the front. If you're a small business and you go to get a loan, they're going to try and look at your finances and they're going to say, hey, you haven't been doing that well lately, and so we can't in good faith give you money because there's a good chance we might not get it back. You might have to close your doors. But alternatively, if you're a business that has actually done fairly well as a result of the past few months, then they're not going to give you money because they're going to say, hey, this is just a short-term blip. Things are going to go back to normal, and so we don't want to base our lending based off of unsustainable business results. So if you're a small business, whether you've done good or whether you've done bad in the past couple of months, either way, that's a reason to not get lent the money that you need. Even if you're doing fine, you've actually had no change, it hasn't gotten worse or better for you, you just need access to the capital. A lot of times small businesses are going to be in industries where banks are not going to lend to just because of the industry. For instance, restaurants right now. As we just looked at from the Yelp data, restaurants are closing their doors all across the country. And so even if you have a restaurant that is doing fairly well, banks are not going to lend to you because your industry is in trouble as a whole. And so they're actually pushing for, hey, we're not going to lend unless these loans are 100% backed by the federal government. Now, just one more kicker that is making it harder for small businesses right now is that many small businesses took an EIDL loan. That was one of the programs that was rolled out as a result of this crisis that was money made available to small businesses. The problem with this is that loan puts the United States government in first place position as a claim on all of the assets for the business. Now, banks will not lend to small businesses unless they can be in first place position on all of the assets in case something goes wrong. And so the fact that all these small businesses had to take these EIDL loans means that now they can't qualify for loans through banks because you've got the government holding a lien on your assets. Now, since small businesses employ most people across America, This is a big deal because small businesses being squeezed and closing down in record numbers means that real people are losing their jobs, and it's not temporary. And remember, this is a crisis that has just been revealed right now, but the trends have been coming for a long time. And the incumbents, the large businesses are favored in these environments, but they're not completely making up for everything that is happening, especially short term. Over 1/4 of Americans missed their rent or their mortgage payment during July. Initial unemployment claims are still extremely high compared to normal. Even the initial claims haven't gotten back down to normal. Mortgage delinquencies are still spiking. And despite what people said at the start of the crisis, consumer debt levels have not gotten better. There is a short-term blip where consumers said, hey, I've got it a little bit extra money right now. I'm going to pay off some debt so that I have some slack later. But that slack has been taken back up again. And contrary to popular economic beliefs, financial mainstream has this all wrong. Elevated debt numbers, elevated consumer debt does not speak health in an economy. It speaks confidence, that is true, but confidence does not mean health. Just because consumers are confident about things doesn't mean that they're right. And it also doesn't always speak confidence. A lot of times, elevated debt numbers just happen out of necessity. If your savings are tapped out and your income isn't covering your expenses because you got a pay cut, you lost hours, or you actually lost your job, debt is the only option. And so the fact that in a crisis we have elevated debt levels right now for consumers is not a good thing. Now, the fact of the matter is that despite the fact that the asset prices are at all-time highs, and despite the fact that small businesses are being squeezed and closed, and despite the fact that it's actually hurting people all across the country, their individual finances, this doesn't mean that asset prices are going to come down. In fact, a lot of times historically, that means the opposite. It means this trend will continue because the wealth and capital that does exist for reallocation will continually be reallocated into the survivors or into the ones that are thriving. And so if you're invested in the Russell 2000 over the past 2 months, and you're looking at the Russell 2000 versus the NASDAQ versus the S&P 500, you might think twice about keeping it in the small businesses. They're the ones getting hurt. They're the ones getting squeezed. They're the ones that don't have access to the capital. I, as an investor, might decide to throw that into the NASDAQ. Yes, valuations are at all-time highs. Yes, that stocks are the most expensive they've ever been. And yes, it's being led by just a couple companies, but the trend is your friend. And while everybody's piling on the bus, while the bubble is going up, I want to be on that ride. And no, I'm not actually suggesting or recommending that. I'm just saying that's the mentality. Now, further than that, all of these things are, at some point down the line, they are a result of the initial cause, which is money printing. And one of the net results of money printing is that asset prices go up. Asset prices are one of the first things that go up when money is printed. And eventually it trickles down to the prices of goods and services, things that people actually have to buy. So it makes cost of living go up next. And then after that, then it finally hits wages. And the Fed just said that for the foreseeable future, there is no change to their monetary policy as far as they can tell. We're going to have extremely easy monetary policy for the foreseeable future, which means that the price of assets will continue to fly further and further away from the reach of the average person as stocks and gold and real estate and assets just continue to get more and more expensive. So they're going to become more and more out of reach of the average person. And it's also going to mean that the cost of living is going to get higher and higher and higher, which means that the cost of production, the cost of actually doing business is going to go up, which is going to squeeze, wait for it, the small businesses. And then the kicker is when it gets so bad, when the federal government starts considering things like price controls and federal minimum wages or universal basic income, those again are going to be band-aids that, just like the last few decades, are going to cause more problems down the line. Now, understanding how these things play out and that these trends are long-term trends and they're not just short-term blips gives one an idea of how you can play this and how you can kind of position yourself so that you're not on the losing end of this. Number one, it's buy assets. And I understand that that's difficult sometimes, but a lot of the major trading firms out there have made it extremely easy for somebody to invest in stock slices or fractional shares. Now, another thing is to buy hard money and to exchange your fiat, exchange your cash, your paper dollars, which are losing purchasing power. You can exchange those for hard money. Now, some people say Bitcoin, some people say gold, some people say silver. I've got plenty of videos about that, but that is definitely one way that you can position yourself in order to protect yourself against the coming madness. And I expect that this will continue at least until after the election, because everybody who is in power right now is doing everything they can to make sure that they can stay in power. And you do not want to have things crumble on your watch. And so I fully expect the things that we've seen over the last couple of months to continue at least until after the election, which means that we will still see more and more of the real economy, economic fundamentals crumbling beneath the surface, while at the same time pushing asset prices to all-time highs. Thank you so much for watching. If you enjoyed the video, please hit that like button for the YouTube algorithms. It really does help out the channel. And subscribe to my new newsletter. It's in the description below, the link that you can subscribe. I send out a weekly email with a few articles that I've found the most valuable that I've discovered that week. You can sign up. It's free. It's in the description below. Thank you for watching. You guys are the best. Have a great day.